All right, welcome to another episode of Deal Flow Friday. I'm your host, David Moghavem. Today we have Paul Schon. Paul is a established developer in LA, been developing for 15 plus years, doing multifamily, over 30 projects and single family homes. So Paul, it's great to have you in the LA office. I know you had to maneuver a lot of traffic with the flood we just had in WeHo today, the sinkholes that are forming. Things like I've read like two people fell into a sinkhole this morning. So it was,
Wow.
yeah, I don't know. I don't know how we're going to fix all that. I think LA has enough issues, but
Yep.
now we have another one. But thanks for making it out. I appreciate it. And good to have you on.
Thanks for having me. I enjoy what you do and I appreciate the opportunity.
Yeah, I see you're a fan of the pod. You're liking the
Yeah.
content.
Yeah.
I
Yeah.
like that. And we were just talking earlier how, I think it's good. We get to talk operator to operator, boots on the ground, what we're seeing out there. And I'm sure for LA development, it's not easy. I mean, for everyone, it's not easy. If anyone's telling you otherwise, they're lying to you. But for LA development, man, it's been tough. I actually was looking at a few deals that are bank owned that were developments. I was looking at like a failed co-living deal.
Yep.
I was looking at a bridge lender that took out the construction loan that now owns it. And I think you're just seeing whoever kind of went vertical during that time. It was hard to get out if as a merchant developer. So I kind of want to hear your take and hear like the details of how this has been versus, the 15 plus years that you've been in the industry. What's different? And we'll just love to hear your take to start there.
Yeah. Well, I'll start with this. I've waved the white flag on ground up development at this time.
Yeah.
So I love developing. It's my favorite
Which
part of the
is,
business.
that's tough. Like, sorry to cut you off. Like,
Yeah.
LA needs housing. LA
Yes.
needs development. And here you are sitting here waving the white flag.
I need a white flag to wave it because rates, mansion tax, or like we've talked about it dozens of times. It doesn't make sense.
Yeah.
Costs are so high. Uh, Permitting costs, getting through the time delays, just multiple of things that just don't make sense to do ground up podium buildings, which is mostly what I've done. So podium, mid rise, 5, 6, 7 story buildings, they just do not make sense. I wrote a pretty interesting post on LinkedIn the other day on a building we bought, and I deconstructed that building because it was a newer building. If we were to build that building today, it would have cost significantly more than what we bought it for. And today in the market, I'm sure you've seen it, you can buy buildings for significantly below the cost it cost the developer to build. It just
Below
doesn't make
replacement
sense.
costs.
Yeah.
Exactly.
I do want to say type 5, 2-story buildings, 3-story buildings might make more sense in a good location where you can get high rents. But what we were building a lot does not make any sense at all. So that's why I waved the white flag and I said I'm on pause, even though I love to develop.
So the type 5, are you waving the white flag on the type 5 stuff?
Yeah, if I see, I'm more focused on buying existing at the moment. I think it just it's that time of the cycle.
No,
I
it
think
makes
in real
sense.
estate, it's like you got to look at the cycles. I think there's a time of the cycle where it makes sense to build, and there's time of the cycle where it makes sense to buy. I think absolutely when the time of the cycle it makes sense to buy versus build.
So let's get into the numbers a little bit. If you saw a development deal that would make sense, what kind of metric would you be leaning in on? Like what kind of yield on cost maybe that looks like?
Yeah,
Like what
yield
would
on cost is the main metric we look at, and you have to be up over a 7,
Mhm.
and you just can't get over a 7 with real numbers and real assumptions today.
Right. And what's factoring into that 7 is obviously costs, but more specifically construction costs, timing costs, financing costs there.
Yeah.
And then also, I guess, to get to a 7, you're reverting maybe like at a 5 or something. But a lot of that spread is maybe someone would say doesn't need to be that much of a spread, but because of ULA, then you have to be at a higher spread than maybe other markets because of that transfer tax.
Yeah, and the time value of money because these projects, like I'll share the first building we built was in 2012. It took us a little more than 24 months from purchase to refinance once stabilized.
Yeah.
right now, that same building would take 4 to 5 years to build.
Yeah,
So
and that's by right.
and that's by right.
Yeah.
So that equity is just sitting there. So yes, you have to have a good spread because of your time value of money.
What's the biggest delay when you're developing deals?
Uh,
When you're saying timing, like what is causing that?
Two things. Actually, entitlements and permitting has gotten better,
Okay.
surprisingly, in the last year, year and a half. But
I remember during COVID that was like an issue, right?
yes, but I think right now the biggest delay, like, and there's multiple, but like it's all still hard to bring in laborers to the job site. So the crews are you got to convince your plumber and your electrician. It's like, hey, send more than 4 guys. We need more of an army here. So that's been consistently challenging. But ever since COVID, building inspectors have been so difficult. You call usually before you would call in for an inspection and the next day the inspector would show up. Now it's sometimes they show up the next day. Sometimes they wait till let's say it's a Monday, they say I'll come in on Friday, and then they don't come in on Friday. So now you're just sitting there. You can't really
Unreliable.
advance
Yeah.
and you're losing weeks just waiting for building inspectors. And don't let me get going on DWP
Yeah.
because then you
It's like
have
a mafia.
yes, completed building. You're paying interest on the entire loan amount because the entire loan amount's been funded, and you're sitting empty with
So
no income.
this exact scenario happened to us at
Yeah.
Tryon. So we were developing deals. We started dabbling into development in LA pre-COVID.
Mhm.
And we had a deal that was completely done
Yeah.
and we just need to hook up to water and power.
Yeah.
And we were waiting on DWP. We were just going through the normal channels in the beginning. Then we're like, why is this taking so long?
Yeah.
We're paying interest on our construction loan.
Mhm.
We need to get it to lease up. We need to just connect.
Yeah.
And then we hired a lobbyist for DWP
Yeah.
just to get an
Yeah.
appointment with DWP
So you
to
can
show up.
provide housing
Yeah.
for this city that needs housing.
That shouldn't
Yes.
happen.
It
That
should
shouldn't
it should
happen.
not
So
happen.
that obviously not only kills returns,
Yes.
but it increases the cost. It increases the timing for us to solve the housing shortage
Yeah, it
here.
makes developers will say, "I don't wanna deal with the city,"
Yeah.
because it's so difficult to add new housing. And that's why a lot of us, a lot of my friends who are also developers, we're all waving the white flag. We're like, until things improve, we're just not gonna develop right now.
Now, I know you were mentioning you were doing some single family stuff. Are you still doing any of that?
Yeah, I'll dabble in single family. It was like from 2009 to 2012 where we did a lot of single family homes. I'll dabble here and there and do a home here and there, but the main focus is multifamily.
Yeah. I mean, single family has its own, headwinds too, and it's not income producing. It could be
Yeah.
tough.
And you don't get
So,
the benefits of being a real estate investor with
right.
the tax treatments, the depreciation, you're yeah, you're charged ordinary income as a
Yeah.
developer.
I remember leading up to this, you were saying you're pretty busy with the deal. Maybe you want to talk a little bit about what you are busy with if it's not development
Yeah,
in
yeah.
LA.
So I think right now, as I mentioned, we're in the time of the cycle where it makes sense more to buy than build. So this is a fun deal. We're in escrow. We're closing at the end of the month.
Nice.
So we built this building and sold it in 2021. So, and we didn't get a crazy price, but we got a good price. We made money, or we hit our promote well, our investors made money. And now I'm buying that same exact deal from the seller I sold it to, the buyer, I guess, that I sold it to. So he's just selling it. It was an opportunity zone deal. He was first on the market, like new to the market, and just got tired of LA's bullshit on
Yeah.
managing property.
So it's just tough managing for him.
Yeah, and he used a third party, and I think you have to manage in-house in the city.
I
You
agree.
you
Yeah.
have to do it
Hmm.
in-house. So, he had a third party management company and just expectations and
And
reality
they just
that
didn't care. Right.
yes,
Yeah.
yes. So I'm excited. I'm buying it. It's funny. I'm buying it for around 30% of what I sold it for, just under 30%, and
30% below or 30% of?
30% below of
Okay.
what I
Yeah. Yeah.
sold it for, and I'm even buying it below what I built it for back in the
Right.
then,
Below
and it was
replacement costs. Yeah.
yeah, below replacement costs, and then it was less expensive than it is to build now. This
Hmm.
was I built it pre-COVID, or
Right.
basically I was wrapping
Yeah.
up during COVID. So it was significantly less expensive to build then than it is now. So
Can you
uh,
share metrics like door per door and
yeah,
yield?
yeah.
Yeah.
So I sold it right around 500 a door. I'm buying it for 340 a door,
Wow.
2021 vintage, non-rent control. Um, just just above a 6 cap,
Wow.
and my debt terms is 6.1. So I'm getting positive leverage day 1. There's not much upside, but I don't see any downside at the
Well,
price I'm buying it for.
is that I agree with you. Is that six cap like true in place? Because you were saying like the third party management, they didn't manage
Yeah.
well. Like so
Yeah, yeah, so it's off my
okay.
expenses.
Okay.
So, it's so since we self-manage, we have a company, ST Living, that we manage around 500 units across LA. We self-manage our buildings. We know our expenses pretty well, and it's off our expenses and the adjusted property taxes,
Yeah.
because the property taxes are gonna come down because
Right.
of our purchase price.
So let me ask you, and now, to getting into management and self managing, what do you think is the difference between some of these third party managers that are struggling versus yourself that's self managing that you have an edge in managing in this city?
I I get calls here and there. We selectively take on third-party management clients, because I don't love the business, but I think it's a necessary business
Right.
if you're gonna own and properties in LA. And man, I see what these third-party management companies charge and how inefficient they are.
Hmm.
And I tell these owners, I'm like, I wish I had the capacity to take on your properties, because I would save you so much money
Yeah.
in operating expenses, because they just charge so much to the property. The way they staff it, though their vendors are so expensive. It's I was looking at a owner who was sending me his operating expenses, and he was paying I think like 525, 550 a month for their landscaping. It was a small property, small
Yeah.
building. And I called my vendor. I'm like, "Hey, how much would you charge for landscaping this property?" He goes, 150 to 175.
Right.
So, and that's across the entire, like, most of the operating
Right. They don't
expenses.
have an incentive to save on that,
No, they
right?
don't.
They don't. So
So I
interests
just
aren't aligned in that regard. And then because we've had some third party managers and we've managed ourselves,
yeah.
and you end up, if you do want to get the cost savings, you end up managing the manager. And so
Yes.
at that point, it's like, all right, if I'm going to run it efficiently, I might as well manage it myself rather than just micromanaging this third party manager.
Yes. Yes. But now you're dealing with the people and hiring in
Yeah.
California, which
Right.
is can get a little complicated.
Hmm.
But if you get the right people on your team, I think it's definitely the way to go.
Yep.
Yeah.
So are you still looking just in LA? Are you looking at any other markets?
Just in LA. This is where I live. This is where our property management company is, with our construction company. We built all of our buildings ourselves. So this is where just I know my
Yeah.
competitive advantages. So I don't want to be going to other markets. I just want to be great at what I do, and what I do is Southern California. I'll look at projects in Ventura, Orange County, San Diego, but that's it. I don't want to go to other markets.
Let me tell you, we're in a lot of different markets, a
Yeah.
lot of different states. We have, office in Miami, office in LA. I like LA right now. It's
Yeah,
funny
I
enough,
agree.
I think back to the basics, I think there's a good supply demand story here.
Mhm.
When you're comparing it to some of the Sunbelt markets,
Yep.
I think there's a little bit of a COVID bounce back happening. Anecdotally, I moved back,
Yeah.
right, from Miami, but I do feel like, taking a step aside, there was a lot of people who moved out of LA, out of California, capturing the growth in other markets. But now we're entering a time where there's a little bit of a economic just sluggishness, right? With the economy we're entering in, it's a little tight for a lot of people. And naturally, I feel like as a result, people are kind of bouncing back to where they were maybe pre COVID. Maybe it's like help with families. Also, in particularly people that are in the younger sector,
Mhm.
right? So I do think that demand kind of shifting back to what it was pre-COVID from household formations, and then also the fact that LA didn't have as crazy of a development boom as some of these other
Mhm,
markets, relatively speaking,
mhm.
with the exception of a few sub markets, right? I just like the supply demand story here.
Oh, and I'll add to that. I agree with what you're saying. I think we
And
lost 2.
everyone rips on LA. Like
Yes,
everyone's it's so easy.
we're
It's so easy anyone that
yeah,
lives here.
yeah, I agree. I go to conferences across the country, and it's like, "What are you doing investing in LA?"
Right.
But I agree. I'm bullish in LA. I think we lost around 200,000 people since COVID, and I'm hopeful that they start coming back. And you start we our rents have been flat. I don't for our portfolio, basically since 2020, they've been pretty flat. And but then I see Inland Empire and I see Phoenix and I see other markets and their rents have gone obviously they're going down now, but they went up so much. And I think during COVID when LA was shut down, it did not make sense to live in
Right.
LA. Why are you going to pay this expensive rents if all the amenities are shut down? But now that LA's amenities are back, I think it's a bargain to live here. You get
Yeah.
a lot bang for your buck, and then especially why I think it makes sense to invest in LA, the cap rates that you're getting here are
S-
better if you're a buyer than the cap rates that you're getting in Inland Empire and in Phoenix and
Right.
which makes in Texas. It makes no sense to me because it's so hard to build here, as we
Right.
were discussing.
Like you're buying a six cap for a newly built deal that you built
E-
formerly, right?
Exactly. So I'm like, okay, but I think I'm getting a pretty solid deal, but let's say even you're buying 5.5 caps for
Hmm.
newer 5.25, 5.5
That's
caps.
still like 50 bips wide of where maybe something in the IE is trading for.
Exactly.
Yeah,
So and it's like I'd rather live here. I think the fundamentals are much better here. There's
for
no
sure.
land. We have an ocean and everything's built out.
Well, it's clear it's because of the mansion tax. It's because of
Yes.
ULA. That's clear. I
The
think ULA
regulations.
has completely decimated the 3 to 5 year buyer in
Mhm.
LA.
Yes.
Uh, which try on. We're one of them. We're a 3 to 5 year holder,
Mhm.
and it's hard to make your promote when your profit and your promote is going towards a transfer tax.
Yeah.
And there needs to be a correction. Is that obviously prices have corrected? Has it been in the full extent where the 3 to 5 year holders can come back? I don't think
No.
so. And that's why you're seeing the yields and less transaction activity.
Yep.
So, but if you're holding longer term, if
Which
you're
is our
holding
mostly our strategy.
exactly, I think you're getting incredible asymmetric yields for that product in this type of market
Yes.
than many of the markets in the country right now.
Yes, I completely agree. I see not much any downside, and I would always tell my friends, I'm like, "Is LA gonna become?" When during COVID, I'm like, "Is LA gonna become the next Detroit? Is the exodus gonna continue?"
It
And then
won't be a Detroit. I mean, but
hold on,
Detroit,
yeah, I just went to Detroit 2
yeah,
weeks ago just for an event, and
was
I
it
came back.
poppin'?
I'm like, "LA will never be Detroit."
Yeah.
Detroit, I had a good time, but it's not a great
I mean,
city.
I mean, there's a reason it's expensive to live here,
Yeah.
right? There's a reason people want to live here, and it has great fundamentals despite all the political headwinds,
Yeah.
things like that. Do you think there's going to be any turnaround with the political headwinds? Do you think it's more of a pendulum that's swinging back, or do you think this is, as someone who's investing in LA, this is what you're dealing with? May even get worse, but hey, this is just the risk of playing in this market.
Yeah, we saw it in San Francisco. So San Francisco turned around,
Hmm.
and I'm hoping that it happens to LA. But even if it doesn't happen, people still need a place to live. And yes, the city makes it a little harder on us to be owners and property managers, but you'll still be able to rent your unit. I don't think it'll go full socialist, so I think we'll be fine. And there's a barrier to entry.
Hmm.
If you understand the rent control laws and dealing with residents here versus dealing with evictions. So even though it's a pain in the ass, I like the barrier to entry.
Yeah, I think every market has its own risk,
Mhm.
and LA, it's the political risk, which is maybe harder to quantify, but we diversified in all these other different markets, and we're finding that there's other types of risk with those markets. Supply,
Mhm.
insurance can run the gamut. So I think it's just important to acknowledge, like, hey, this is a market that has its risk, maybe harder to quantify.
Yeah.
But for instance, in the deal you're buying, a six cap for new construction in a strong market, I feel like despite the political risk, you're getting a good return, risk adjusted.
Yeah. Agreed.
I know you don't want to talk too much about co-living, but I just got to ask, like, what happened? Was it just a doomed idea from the start? People jumped on it. It had a lot of hype. Could have been a good affordable alternative to the housing crisis we had. I think there was a lot of hype around it, but it flopped clearly.
Yes. We were some of the we got super excited about co-living. We built 2 co-living buildings, and at first, it was actually pretty good. We were renting at we built one in Koreatown, East Hollywood. We're getting around 1,600, 1,650
A
for
room.
a room, and we're building 5 rooms.
You could just rent your own studio for that, no? But it's an older, like a
So, that
1920s
was
studio is probably
then.
then. Yeah.
That was then.
Yeah.
Now that same building, we're getting 1,350.
Okay.
So there was a glut of supply because a lot of people got excited for co-living, and now there's quite a big competition, and so we had to bring our rents down, and the part that we knew that didn't I don't think anyone really underwrote correctly is the occupancy. It is
Mhm.
much harder to keep a our portfolio runs around a 95% occupied,
The non-co-living
the
portfolio.
non-co-living,
Mhm.
but the co-living portfolio, it's 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 hard to get it above continuously above a 90. Like, our goal is to hit just be right always above 90, and because there's so much turnover, because people come, they're usually people that are new to LA, which they want a place and they wanna build a community, so in theory, it made a lot of sense, but there's a lot of turnover, and you have to keep it clean because there's 5 people sharing a kitchen in the living room, so the operating expenses is higher. So I in theory, it still makes sense because you're renting it on a way higher rent per square foot, but the operating expense and the occupant and the vacancy rate on them is what kills the numbers.
Yeah, and there wasn't enough data or any type of,
Yeah,
like data,
and
like
also,
comps to support that, like
we
what
all
it would
built
run
at the
from.
wrong time
Right.
during COVID.
Right.
So when a lot of waiters, bartenders that move to LA that wanna break into entertainment our that was our renter pool.
Mhm.
And when COVID happened and everything got shut down, they stopped moving, so everyone had to lower their prices. Will it come back? Will we get up high? Maybe, but I wouldn't do it, and also financing, it's tough to finance.
I have a funny story. So I had a intern. This was like when co-living was,
Mhm.
when was that? Like 2018,
Yeah.
2019? Yeah,
Yeah,
around
yeah.
that time.
It was
So
hot.
I had an intern. We were looking at some co-living deals. It was when we were getting into development, trying to make sense of it. And I had an intern who was living in one of these.
Yeah.
And he was in one bedroom of like a 5 bedroom, one of the like that you were
Yeah.
just talking about. But the fifth bedroom, and he became friends with the other like three others. So it was like 4 out of 5 were occupied.
Yeah.
But the fifth bedroom, they couldn't rent out. And the reason was these four would like kind of like gang up and try to like make sure that room was vacant because they didn't want to have like another person in there just
Yeah.
to have like extra space. Like that's something that like you can't it's like hard to underwrite or hard
Yes.
to like
Yes.
that's something that just comes up in there that you don't have enough data points to extrapolate like how these deals run, what the
Yeah.
turnover looks like, what are the factors that are beyond the numbers.
Yeah.
And so like that was an interesting
Yeah. That's funny.
psychological experiment
Yeah.
there.
And, like, because we manage our co-living buildings, sometimes roommates fight,
Yeah.
and you have to separate them, and then some have ESA dogs, and some are allergic to dogs, so you're dealing with all these other so
If
I
traditional multifamily is hard to manage, like I can't even imagine how
yeah,
co-living is.
exactly, so as a manager, it's a lot more intense to
Yeah,
manage than traditional multi.
right. Let me ask you a little bit about ED1.
Yes.
Um, I would look, first of all, for you to maybe give like a high level of what it is for the listeners who don't know, and talk about, have you guys done like ED1 deals or?
Yeah, so I'll start. You probably know the technicalities better than I do, but when Mayor Bass came in, she started this ED1 program, which at the time I'm like, oh, this is a pretty solid program, and I think it has been successful. There's been a lot of permits that have been uh, issued, and I think some people have gone vertical on them, and so it is adding new supply to the market, more of an afford. So it's an affordable product. You get basically unlimited density. You
Mhm.
get reduced parking, you reduce setbacks. So it makes a lot of, for a developer, you're building cheaper. You get, because you get a lot more units and you don't need the parking. Parking's probably it is the most expensive part of a construction
Right,
project.
subterranean too, right?
Yeah. Yeah, you get to avoid all that. So in theory it made sense, but I we actually bought a site in Hollywood to build 97 units, ED1, and I at first I was really convinced by it, but then we're I started struggling with the similar to co-living operationally without parking.
Yeah,
How do you rent those? So I think and we ended up entitling it and selling it and it went vertical, so at least we're getting 97 more units in
mhm.
Hollywood, but I had it financed. I had the equity, I had the debt, I was ready to go, and my investor kept asking me, "Paul, what are we gonna sell this for?" And I couldn't give him an answer, and that's why we didn't do it, because
Yeah,
I was not convinced on the exit price, because right now, let's say new construction is selling between 5 and 6 in LA. Um, what is an affordable product, because there is a covenant, you
right.
have to keep it at 80% AMI, an affordable product with no parking gonna sell for? I didn't know. And I couldn't look at my partner in the eyes and say, "We're gonna sell for X," even though it is significantly less expensive to build, significantly.
Just
Um,
not enough data points.
Not enough data
Have
points.
those data points come about at this point?
No, not
No?
yet,
Okay.
not yet. And just being a buyer myself in today's market, what would I pay for an ED1 completed project? I don't know.
Yeah,
Like,
similar to co-living too, it's smaller units, right?
yeah.
Just naturally from the density, and then no parking, you're gonna get naturally more turnover too on
I think the
those.
occupancy, I think for all the ED1 developers, you should not underwrite a 95% occupancy, you should
Right.
underwrite 90%
Yeah.
occupancy. And
Yeah.
that kills that's
Yeah.
a lot.
And probably higher turnover. And
Yes.
then there's probably a cap rate premium, like a higher yield
Yes, absolutely.
than a traditional new construction deal, just given the durability of those tenants and the income,
Yeah,
right?
yeah. And leasing velocity, like, as a
Mhm.
developer, one of the things we look at is like, "Okay, how long is it gonna take us to lease up a completely empty building?"
Yeah.
And it takes 3 months, 6 months, a year at most. For a ED1 deal, how long is that gonna take?
Now, does ED1, when you sell it, do you get hit with ULA or is it
Yes.
waived? You do.
Yeah, you get hit with ULA unless you sell it to a nonprofit,
Okay.
but to a market rate, to a
Even though
affordable
it's an
buyer.
affordable deal, if you're not a 501(c)(3), if you're not a nonprofit, then you're gonna get hit with ULA.
Yes,
Wow. Okay.
yes, yeah. So, to me, those were the main things on why we just couldn't get comfortable with doing ED1, but
So then you have to be at like a 7.5, right? If you're gonna expand the
plus,
exit
yes,
cap, then a typical, I'm going back to your the beginning when you said you need to be at a 7 for
yeah,
traditional multi. Probably need to be a 7.5 because you're gonna expand the cap rate.
yes,
You're gonna and your rent roll is not gonna come out to the same NOI as traditional because of the turnover, the occupancy, all
yeah,
that. So that's tough.
that's
That's
tough.
tough to flip out of.
Yeah, and there's some completed ED1 deals just sitting on the market,
Yeah.
and no one wants to buy them, and
What
I
kind of cap
understand.
rate do they like? If do you know what the cap rates are?
I
Like,
have no idea what they
yeah,
get, but
yeah.
like, if they offered you guys, would you guys buy a 7.5 cup ED1 deal?
A 7.5 is interesting for new construction, but it's, yeah, the devil's in the
Yeah,
details,
and the
right?
management of that, because
Yeah.
every year you have to, do the
You might get some good financing from it though.
it's
No?
true.
Right? Like with the like given it's affordable, it might have some good financing from the agencies. So like it
Mhm,
could be a good cash flow play,
mhm.
right? Maybe not again, like you can't flip out of that.
You can't.
That's going to be tough. So,
Yeah.
okay.
But in theory, I like the program, and if LA does become a little more transit friendly where not everyone needs a car, it might work,
Yeah.
but we're just not there yet.
So, Paul, I mean, I guess maybe to wrap it up, uh as you said, you've waved the white flag, but maybe some advice for people that want to get into development, get into your shoes. What would be some advice to them besides don't do it right now? But
No,
yeah,
I think it does make sense to
yeah,
do it if you're doing type 5,
uh huh.
3-story, buildings. I think SB9 makes a lot of sense right now
What's
for
that?
so Senate Bill 9, where basically you could get to buy a house and add 3 to 4 units.
Oh, is that the ADU
The
play?
ADU
Yeah,
law,
yeah,
yeah.
yeah.
I think that makes sense
Mm-hmm.
to get started to start building a portfolio. I think, it's way faster to build than what we build. It's, way less expensive to build, and you can do it in a good neighborhood.
Mm-hmm.
And so I think to someone really getting started, it's like buy your home, do some units in the back, become a landlord, rent them out, understand the fundamentals. I do think understanding operations and property management is probably one of the most important things that everyone should study.
Yeah.
It's I think it's so important to understand the expenses and the rents. So I think that makes sense. I think Senate Bill 1123, where you can build up to uh, 10 townhomes and for sale, I think that makes sense too. Um, so I would say explore those. I think those are new bills that came out that make a lot of sense in California right now or in LA. And then, also, if you can control a deal, whether it's a future development deal where you can get a long entitlement, long escrow in a good pocket where it would pencil, and bring it to a developer and say, "Hey, I want to be part of this deal. I'm bringing you a solid deal. Let me be part of the development team or the own,
If you own a piece, you're saying if you own a piece of
or you
land
control."
or you control.
You can
Okay.
tie up a piece of land and then bring it to to developer and say, "I wanna be part of this deal," and more like a mentorship program
Right.
and get part of the promote and part of the upside. I think that's one way to do it, or an existing apartment building.
Yeah.
Existing apartment building with upside, if you can control it and bring it to an existing operator and say, "Hey, I wanna learn, this is I'm bringing you something of value. Let's figure out a way to partner together." I think that's a
Yeah.
good start too.
Going back to the ADU play, what is it called again? SB9?
SB9, Senate
Yeah.
Bill 9.
I didn't know the formal term for it, but my family, we have like a 15 unit and we're thinking of doing some ADUs on it and it penciled really nicely.
Yeah.
Then when we got into the weeds, we saw that we had to upgrade the main panel.
Mhm.
Then we talked to the city and they said, well, if you're going to upgrade your main panel, I might be getting this wrong, but like if you upgrade the main panel, then you have to also upgrade the electrical for the street. Then if
Yes.
you're going to upgrade the electrical for the street, we're actually moving all the electrical underground.
Yes.
So you have to go trenching. And then it's like, what am I paying for right
Yes.
now? Which
That
is
yeah, that
but not shutting down the plan because not every property is in that position. Some already have it upgraded and things, but
yeah,
that was just a specific thing I ran
you
into.
were right in that, like, once you start getting from up close to 20 units, you have to upgrade to a higher panel, it
Right.
just kills the deal. But if you're in a house and you're adding 3, 4 units to the back, that will never happen to you.
Okay.
There's
So it's
plenty of
different
power.
when it's like a single family or like a
Yeah.
duplex that you're adding a unit.
Exactly.
Okay.
Once you get to high density 20 unit plus units with an elevator, that's when you gotta upgrade
Yeah.
that because obviously more electricity pumping through the building.
Right. Right. Have you done any of those on like the smaller deals?
No, no. I've looked into them, but I think right now my time is better spent looking at
Yeah, you need
bigger
scale.
apartment buildings.
Yeah,
Yeah.
you need scale.
Yeah.
All right. Well, Paul, I really appreciate you hopping on.
Yeah.
It was a pleasure. And
Thanks for having me.
yeah, I know you've been a fan of the pod, so to
Yes.
actually have you on and give your perspective, despite everyone ripping on LA for whatever reason, I actually think it's we're at the bottom and it's only going to go up. I actually really feel
We're
like
gonna
that.
be laughing at them at 27
Yes.
when they're still gonna be struggling with oversupply, and we're gonna be like, "We don't have oversupply
Yeah.
here in LA," and we're gonna start seeing rent growth. So I think we're gonna
Or
be
28. Everyone talks about Olympics. 28. That's like when it's
yeah,
going to all come. So
yeah,
we'll see. I mean, we'll see. I'm excited to see what these next few years happen in LA.
yes.
Well, appreciate it.
Yeah,
Good to have
thanks
you
for
on.
having me.
Awesome.